Debt is a critical element in economic systems, but it is often misunderstood. The common assumption is that debt, by itself, is the root cause of economic problems. However, this view oversimplifies a far more complex issue. Debt is simply a tool that facilitates economic activity. It can be used for productive investment, consumption, or even to weather temporary financial downturns. The real problem arises not from debt itself, but from how it is managed within the larger context of economic cycles. Economic cycles, phases of expansion and contraction, are an inherent part of market-driven economies. These cycles are driven by a range of factors, including technological advancements, demographic changes, shifts in consumer preferences, and, importantly, the availability of credit. When the economy is expanding, debt tends to increase as businesses and governments borrow to invest in growth. Individuals may also take on more debt as their incomes rise, and optimism about the future fuels demand. At this stage, debt can be a positive force, enabling increased investment and economic activity. However, as economic cycles move toward their peak, the accumulation of debt can become problematic. The increase in borrowing may outpace the underlying growth in income or productivity. When the economy starts to slow, or when the value of borrowed assets declines, the ability to repay that debt becomes strained. In these downturns, the burden of debt can exacerbate the negative effects of the economic cycle, triggering a wider financial crisis. This is where the risk lies, not in the debt itself, but in the point at which debt levels become unsustainable relative to economic growth. Debt is an important part of the expansion phase of the cycle, but the nature of debt can change significantly as the cycle progresses. During periods of growth, borrowing is often seen as an investment in future returns. Businesses may take on debt to expand their operations. Governments may borrow to fund infrastructure, and individuals may use credit to purchase homes or fund education. This form of debt is productive, as it is used to generate future income or value. However, as debt levels rise and the economy begins to approach its peak, the nature of borrowing often shifts. The debt taken on may no longer be tied to productive investments, but rather to consumption or speculative activities. In this phase, debt becomes more risky and less likely to generate returns that exceed the cost of borrowing. The tipping point comes when debt no longer grows in sync with economic fundamentals. As the economy contracts, the return on debt investments diminishes, making it more difficult for borrowers to meet their obligations. This can lead to a vicious cycle. As debt burdens increase, businesses and consumers cut back on spending, causing a further slowdown in economic activity. The result is a deflationary spiral that can lead to widespread defaults and bankruptcies. The bigger the debt pile, the harder it is to recover from such a downturn. The dynamics of debt also vary based on the structure of the economy. In an economy heavily reliant on debt-driven consumer spending, for example, the contraction in credit can lead to a rapid and severe downturn. In contrast, economies where debt is tied more closely to productive investment may have more resilience. The key is the ability to manage debt effectively through all stages of the economic cycle, ensuring that it is used to support long-term growth and not merely short-term expansion. The challenge, then, lies in understanding the nature of the debt cycle and taking action to manage it effectively. One of the most critical aspects of this management is the ability to recognize when debt levels are reaching unsustainable levels. In many cases, the signs of a looming crisis, such as rapid increases in borrowing, speculative behavior, and an over-reliance on credit to fuel growth are apparent long before the downturn actually occurs. At this point, the role of policymakers, financial institutions, and businesses becomes crucial. By adjusting monetary and fiscal policies, they can help smooth the transition from expansion to contraction and prevent excessive debt from derailing the economy. The idea of managing debt through cycles extends beyond simply avoiding the peak of the cycle. It also involves understanding how to use debt strategically during periods of contraction. During a recession, for example, borrowing can be used to stabilize the economy, fund essential public services, and encourage investment in future growth. However, this borrowing must be done judiciously and with an eye toward the future. Debt can support economic recovery, but only if it is managed responsibly and in a way that supports long-term sustainability. Ultimately, the relationship between debt and economic cycles is a balancing act. When used wisely, debt can be a powerful driver of growth. When mismanaged, however, it can lead to severe economic downturns. The key to navigating the complex dynamics of debt lies in understanding the cycles, recognizing the risks associated with excessive borrowing, and taking steps to manage debt in a way that ensures long-term economic stability. In this way, debt is not the problem. It is how debt is handled throughout the various stages of the economic cycle that determines whether it contributes to prosperity or becomes a source of crisis. The nature of debt has undergone significant changes over the past few decades, particularly in the context of the global economy. Historically, debt was seen primarily as a tool for businesses and governments to finance projects, expand operations, or manage cash flow gaps. Individuals also took on debt to fund homes, education, and other essential purchases. In the traditional model, debt was relatively straightforward. It was either a private loan, a government bond, or corporate debt, each with relatively clear terms regarding interest rates, repayment schedules, and the risks involved. However, in recent years, the complexity and scope of debt have evolved, especially in response to new technologies, financial innovations, and the globalization of financial markets. One of the most profound changes in the nature of debt has been the rise of digital currencies and blockchain technology. These innovations are fundamentally altering how debt is issued, managed, and traded. With digital currencies, particularly stablecoins and central bank digital currencies, CBDCs, the way debt is backed, structured, and even transacted has become more fluid and decentralized. Traditional systems of credit creation, such as banks issuing loans based on fractional reserve banking, are being complemented, and in some cases disrupted, by blockchain-based lending platforms and peer-to-peer lending networks. This shift is lowering transaction costs, increasing transparency, and providing access to debt for a wider range of individuals and businesses, including those who might have been excluded from traditional banking systems. In addition to the advent of digital currencies, another major transformation has been the growing role of central banks in managing the money supply and interest rates. While central banks have always played a critical role in monetary policy, their influence has expanded dramatically over the past decade, particularly following the 2008 financial crisis. In the aftermath of the crisis, many central banks adopted unconventional monetary policies, such as quantitative easing, where they injected large amounts of money into the economy by purchasing government bonds and other assets. This policy led to a significant increase in debt, both at the government and corporate levels. While these measures were initially intended to stabilize financial markets and spur economic growth, they also had the effect of driving down interest rates to historically low levels, making it easier for both governments and corporations to take on more debt. This shift has led to a fundamental change in the way debt is viewed. Low interest rates have incentivized borrowing across all sectors of the economy. Governments, for instance, have taken on large amounts of debt, often to fund social programs, infrastructure projects, or bailouts during times of crisis. Corporations have similarly taken advantage of cheap borrowing costs to finance expansions, mergers, and acquisitions, often using debt to fuel growth rather than relying on equity. This has created a situation where debt levels in both public and private sectors are at record highs, even as global interest rates remain low. The result is a growing reliance on debt to fuel economic activity, with the implicit assumption that this trend can continue indefinitely. However, the changing nature of debt also introduces new risks. With interest rates at historic lows for an extended period, there is the potential for a sudden and sharp rise in borrowing costs. If interest rates were to increase significantly, whether due to inflationary pressures, changes in central bank policy, or external shocks, the burden of existing debt could become unsustainable. This risk is compounded by the fact that much of the new debt is being issued in non-traditional forms, such as corporate bonds with longer maturities or exotic financial products like collateralized debt obligations, CDOS, and asset-backed securities, ABS. These instruments, while initially designed to offer higher yields and diversify risk, can quickly become problematic when markets turn sour, as seen during the global financial crisis. Moreover, the rise of digital finance and decentralized lending platforms has introduced an entirely new class of creditors and borrowers. While this democratizes access to credit, it also creates a less predictable environment for debt issuance and repayment. The lack of regulation in some of these new financial markets means that credit conditions can shift rapidly, creating potential risks for investors and borrowers alike. Unlike traditional banks, which are subject to stringent regulations and oversight, decentralized platforms often operate in a gray area where the rules of engagement are still being developed. This uncertainty raises concerns about the stability of these markets and the ability of borrowers to manage their debts in the face of changing conditions. Another critical factor in the changing nature of debt is the increasing interconnectedness of the global financial system. As economies and financial markets become more globalized, the risks associated with debt are no longer confined to national borders. A financial crisis or debt default in one part of the world can have ripple effects across the entire global system. This interconnectedness has made it more challenging for policymakers to manage debt levels, as decisions made in one country can have unintended consequences for others. Moreover, the global nature of debt means that countries and corporations are increasingly dependent on foreign investors to fund their borrowing needs. This reliance on external capital can leave countries vulnerable to changes in investor sentiment or fluctuations in foreign exchange rates. The nature of debt in the modern era is not just about the amount borrowed, but also about how and where that debt is sourced, how it is structured, and what risks it carries. As financial systems evolve and new technologies disrupt traditional practices. The way debt functions in the global economy will continue to shift. While debt remains a vital tool for economic growth, its increasing complexity and interdependence with other financial markets and technologies create a much more volatile landscape. Managing these risks will require a new level of sophistication and foresight from policymakers, investors, and borrowers alike. The key challenge moving forward will be to understand these new dynamics and adjust strategies accordingly to ensure that debt continues to serve as a productive force in the economy rather than a destabilizing one. Central banks and fiscal policies play an essential role in shaping how debt impacts economies, particularly in times of uncertainty or crisis. Their decisions determine not only how much money flows into the system, but also how that money is allocated, spent, and managed. The interplay between monetary policy, which is largely the responsibility of central banks, and fiscal policy, which falls under governments, often defines the trajectory of debt cycles and, by extension, the stability of the global economy. Understanding this relationship is critical because while debt itself is not inherently dangerous, the policies that manage it can either sustain growth or create systemic risks. Central banks are at the heart of monetary policy. Their primary tools include setting interest rates, controlling the money supply, and, in recent decades, engaging in more unconventional methods like quantitative easing. By lowering interest rates, central banks make borrowing cheaper, encouraging businesses to invest and consumers to spend. This stimulates economic activity and can lift an economy out of stagnation. Conversely, raising rates makes borrowing more expensive, which can slow growth but also helps control inflation. The balance between these objectives is delicate, especially when debt levels are high. Prolonged periods of very low interest rates can encourage excessive borrowing, leading to an accumulation of debt that may become difficult to manage if conditions change. At the same time, raising rates too quickly can cause a debt crisis by making repayments unsustainable for borrowers who became accustomed to cheap credit. Over the past several decades, central banks have increasingly turned to unconventional measures in managing economies through debt cycles. Quantitative easing, for example, involves buying government bonds and other financial assets to inject liquidity into the system. While this supports borrowing and spending, it also increases the overall level of debt in the system and creates distortions in financial markets by pushing investors toward riskier assets in search of higher returns. In the short term, these policies can be effective at preventing economic collapse, as seen during the global financial crisis and later during the pandemic. But in the long term, they raise concerns about asset bubbles, wealth inequality, and whether debt-fueled growth can truly be sustained without underlying improvements in productivity. On the other side of the equation lies fiscal policy managed by governments. Fiscal policy decisions involve how much a government spends, how much it taxes, and how much it borrows. During downturns, governments often increase spending and reduce taxes to stimulate demand, financing these activities through borrowing. This use of debt can be productive when it funds infrastructure, education, healthcare, or other long-term investments that improve economic capacity. However, when fiscal spending is directed towards short-term consumption or politically motivated projects, it may add debt without generating sustainable returns. The effectiveness of fiscal policy, therefore, depends heavily on whether debt is being used to invest in the future or merely to cover immediate shortfalls. The interaction between central banks and governments is crucial. In some cases, central banks and fiscal authorities work in harmony. Governments issue debt to stimulate growth, and central banks support this effort by keeping interest rates low or purchasing government bonds. In other cases, however, their policies may clash. For instance, a government may pursue aggressive spending policies that drive up inflation, while the central bank tries to rein it in by raising interest rates. Such conflicts can create volatility in financial markets and uncertainty about the future direction of debt and economic growth. In the modern globalized economy, the role of central banks and fiscal authorities has become even more complicated. Because capital flows freely across borders, decisions made by one central bank can affect economies worldwide. For example, if a major central bank raises interest rates, capital may flow out of emerging markets and back into safer assets, leaving those countries with weaker currencies and higher borrowing costs. Similarly, fiscal policies in large economies can have ripple effects across global supply chains, trade balances, and international debt markets. This interconnectedness means that coordination, or at least awareness of global implications, is critical when central banks and governments make decisions about debt. Another layer of complexity is the political dimension. Fiscal policy is deeply tied to political processes, with decisions about spending and taxation often driven by short-term electoral considerations rather than long-term economic sustainability. Governments may choose to accumulate large debts to fund popular programs or avoid raising taxes, leaving future administrations to deal with the consequences. Central banks, though theoretically independent, are not immune from political pressures either, especially when their decisions impact unemployment, inflation, or financial markets in ways that affect public sentiment. This tension can complicate the ability to manage debt effectively over the long run. The effectiveness of central banks and fiscal authorities ultimately depends on their ability to maintain balance. Debt can be a powerful tool for stimulating growth, managing crises, and building the foundations of future prosperity. But when monetary policy keeps borrowing costs artificially low for too long, or when fiscal policy spends without regard to sustainability, debt turns from a tool into a burden. The challenge in today's environment is that both central banks and governments are operating in uncharted territory, with global debt levels at record highs, inflationary pressures reemerging, and new financial technologies reshaping the landscape. The key is not to view debt as an enemy, but as a force that must be managed with discipline and foresight. Central banks must carefully balance their dual objectives of growth and stability, while governments must ensure that borrowed funds are invested in ways that strengthen the long-term resilience of the economy. The success or failure of these institutions in working together will largely determine whether the growing mountains of debt become a source of progress or a trigger for instability. Debt is not simply an economic matter confined to balance sheets, financial markets, or government budgets. Its consequences extend deeply into the social and political fabric of societies, shaping the way people live, the opportunities they have, and the stability of the institutions they depend on. While the mechanics of debt can be understood in terms of borrowing, lending, and repayment, the broader implications reveal themselves in the lived experiences of individuals and communities. The distribution of debt, the burden it creates, and the responses to it often determine whether societies move toward greater cohesion or fall into division and unrest. One of the most visible social implications of debt is its relationship with inequality. Debt can be a powerful tool for wealth creation when used for education, home ownership, or starting a business. Yet access to affordable credit is not distributed evenly. Wealthier individuals and corporations often have greater access to low-interest loans, enabling them to expand their wealth, while lower-income households face higher borrowing costs, predatory lending practices, or limited access to credit altogether. This creates a cycle where those who already have resources can leverage debt productively, while those who do not are either excluded from opportunity or trapped in burdensome debt that limits their upward mobility. Over time, these dynamics deepen income and wealth inequality, creating stark divisions in society. Debt also plays a critical role in shaping generational outcomes. Younger generations often carry the burden of student loans or face housing markets inflated by years of cheap credit and speculative borrowing. Meanwhile, older generations may benefit from accumulated assets that rise in value as debt-fueled liquidity drives up prices. This generational imbalance creates social tension, as younger people see fewer opportunities for financial stability, while being asked to shoulder the long-term costs of national or corporate debt. When entire generations feel locked out of prosperity, frustration grows, and this discontent can spill into politics, fueling movements that demand structural change. At the national level, government debt has profound political implications. When governments borrow heavily, the choices they make about how to spend or repay that debt influence the social contract between citizens and the state. Borrowing to fund infrastructure, healthcare, or education can strengthen public trust and improve quality of life. However, borrowing to cover short-term deficits or fund programs without sustainable planning can eventually lead to austerity measures when debts become too large. These measures, cutting public services, raising taxes, or reducing social benefit, often fall disproportionately on lower and middle-income groups, fueling resentment and eroding confidence in political institutions. History shows that high levels of debt often coincide with periods of political instability. When governments struggle to meet debt obligations, currencies weaken, inflation rises, and unemployment can increase. These conditions create fertile ground for social unrest. Citizens who feel the economic system is stacked against them may lose faith in traditional leadership and turn to populist or radical alternatives. Political polarization often intensifies as parties and leaders blame each other for the debt crisis, creating gridlock that makes effective solutions harder to achieve. The erosion of trust in institutions can be one of the most damaging long-term consequences of unsustainable debt. On the global stage, the politics of debt also create tensions between nations. Countries with high external debt are vulnerable to the demands of creditors, whether foreign governments, international institutions, or private investors. Debt negotiations, restructuring, or defaults can strain diplomatic relationships and undermine sovereignty, as creditor nations or institutions impose conditions in exchange for relief. These conditions, often referred to as structural adjustments, can include demands for reduced government spending, privatization of state assets, or liberalization of markets. While such measures are intended to restore fiscal discipline, they often provoke domestic backlash as citizens see their governments forced to make painful decisions under external pressure. This dynamic highlights how debt can shape not just domestic politics, but also international power relations. Debt also influences the way societies view fairness and justice. When financial crises occur, the perception of who bears the burden becomes a defining issue. For example, when large corporations or financial institutions are bailed out during times of distress, while ordinary citizens are left to face job losses, foreclosures, or reduced benefits, people question whether the system is equitable. This perception of injustice can erode the legitimacy of economic and political systems, creating lasting disillusionment with both markets and governments. Movements demanding accountability, reform, and redistribution often grow out of these moments, reshaping political discourse for years to come. At the same time, debt can act as a unifying issue if managed transparently and fairly. Governments that openly communicate the necessity of borrowing, clearly explain the intended long-term benefits, and distribute both the costs and rewards equitably can maintain or even strengthen social cohesion. Citizens are more likely to support collective sacrifices if they trust that the burden is being shared fairly and that the borrowed resources are being invested in ways that benefit the broader community. Transparency, accountability, and equitable policies are essential to preventing the negative social and political fallout of debt. The implications of debt extend beyond numbers on a ledger. They shape the opportunities individuals have, the relationships between generations, the trust people place in their leaders, and the stability of nations on the world stage. While debt can be a valuable tool for growth and development when it is concentrated, mismanaged, or perceived as unjust, it becomes a catalyst for division and unrest. The challenge for societies is not to eliminate debt, but to manage it in ways that foster fairness, resilience, and long-term stability. In the end, how debt is handled has as much to do with the strength of social and political institutions as it does with economic fundamentals. Debt, when viewed through the lens of long-term investing, takes on a meaning that goes beyond simple borrowing and repayment. It becomes a key variable in understanding how economies evolve, how markets behave, and how investors position themselves to build and preserve wealth across decades. Debt can act as both a catalyst for growth and a source of instability. For investors, the ability to interpret where debt stands in a broader cycle, how it interacts with interest rates, and what it means for future returns is essential for navigating the complexities of the financial world. Long-term success often depends not on reacting to short-term fluctuations, but on recognizing how debt shapes the larger economic landscape. Debt cycles have a profound influence on investment strategies. In the early stages of a cycle, when borrowing costs are low and economic activity is accelerating, debt tends to fuel expansion. Companies borrow to expand operations, consumers borrow to spend, and governments borrow to invest in infrastructure or stimulate growth. This creates a favorable environment for investors as corporate earnings rise, asset prices appreciate, and confidence spreads across markets. Equity markets typically perform well during these phases, as optimism drives valuations higher and credit remains accessible. For long-term investors, understanding that debt is driving much of this growth allows them to participate in the upside while remaining mindful of the eventual shift in conditions. As the debt cycle matures, the risks begin to increase. Borrowing often extends beyond productive investments into speculative activities. Companies may take on excessive leverage to buy back shares or engage in mergers, while individuals may borrow to purchase assets at inflated prices. These behaviors push markets higher in the short term, but create vulnerabilities beneath the surface. Long Long-term investors must recognize when debt-fueled growth is no longer sustainable and position themselves accordingly. This might involve reducing exposure to overvalued assets, diversifying into safer investments, or holding liquidity in anticipation of better opportunities when the cycle turns. The turning point of a debt cycle can be especially critical for investment strategy. When debt burdens become unsustainable, economies slow, defaults rise, and asset prices often fall. Investors who have prepared for this phase can not only protect their portfolios, but also take advantage of opportunities created by distressed valuations. For instance, during recessions or financial crises, assets are frequently sold at prices far below their intrinsic value, providing patient investors with the chance to achieve strong long-term returns. Understanding the role of debt in driving these cycles allows investors to avoid being blindsided by downturns and instead view them as integral parts of the investing journey. Interest rates play a central role in the relationship between debt and investing. When interest rates are low, debt is cheap, and the environment tends to favor riskier assets such as stocks, real estate, and private equity. As rates rise, however, the cost of debt increases, squeezing corporate profits, slowing consumer spending, and reducing the attractiveness of leveraged investments. Long-term investors must pay close attention to how debt interacts with interest rate trends, as these dynamics often set the stage for shifts in market performance. Ignoring this relationship can lead to being overly exposed to sectors or assets that are vulnerable when conditions change. The influence of debt also extends to government policy and its impact on markets. When governments borrow heavily to stimulate growth, this can create tailwinds for investors by boosting demand and supporting asset prices. Yet it also raises questions about sustainability, inflation, and future tax burdens. Investors with a long-term perspective must weigh the benefits of such policies against the risks they create. For example, large amounts of government debt may eventually lead to inflationary pressures, which erode the real value of investments unless portfolios are structured to account for them. This might involve holding assets that perform well in inflationary environments, such as commodities inflation, protected securities, or real estate. Another dimension of debt in long-term investing is the global aspect. In an interconnected world, debt dynamics in one region often ripple across others. A debt crisis in a major economy can trigger capital flows, currency fluctuations, and market volatility worldwide. For long-term investors, understanding global debt trends is as important as analyzing domestic conditions. Diversifying geographically and being aware of cross-border risks helps reduce vulnerability to localized debt shocks and positions portfolios to benefit from opportunities that may emerge in different parts of the world. The long-term investor's approach to debt is not about avoiding it altogether, but about integrating its cycles and implications into a broader strategy. Debt is an inevitable feature of modern economies, and its influence on asset prices, interest rates, and government policies is inescapable. The key is to recognize where in the cycle debt currently stands and to adjust expectations and allocations accordingly. This perspective allows investors to avoid being overly optimistic during times of easy credit or overly pessimistic during downturns. Patience and discipline are critical qualities for navigating debt cycles as a long-term investor. Markets may swing dramatically as debt expands and contracts, but those who maintain perspective on the underlying dynamics are better equipped to make rational decisions. Instead of being whipsawed by short-term movements, they can focus on identifying enduring opportunities, protecting capital when risks are high, and deploying it when conditions are most favorable. In the end, debt is not just an economic statistic or a financial tool. It is one of the defining forces that shape long-term investment outcomes. Its cycles dictate when markets flourish, when they falter, and where the greatest opportunities lie. Investors who appreciate this dynamic and align their strategies with it are far more likely to succeed over the long run, turning the inevitability of debt from a source of risk into a framework for resilience and growth.